Picture this. A room full of Nobel Prize winners, some of the most brilliant minds in economics, managing a hedge fund with mathematical precision. For years later, they lose $4.6 billion in a matter of weeks. Or consider this. PhDs from top universities, falling for obvious Ponzi schemes, losing their life savings. Here's the uncomfortable truth. Intelligence doesn't protect you from financial disasters. In fact, it might make you more vulnerable. Today, we're diving into the psychology behind why smart people make terrible financial decisions, and what we can do about it. Welcome back to the series. There's a paradox at the heart of personal finance. The smartest people in the room often make the dumbest money mistakes. This isn't about lack of information. It's not about education. It's about something deeper, something hardwired into how we think. Behavioral economists like Daniel Kahneman and Amos Tversky spent decades uncovering this. They discovered that our brains, brilliant as they are, weren't designed for optimal financial decision-making. They were designed for survival, for pattern recognition, for quick judgments in a dangerous world. But those same mental shortcuts, those cognitive tools that kept our ancestors alive, become liabilities when dealing with money. Over the next 19 minutes, we'll explore exactly how this happens, examine real-world disasters, and build a framework for better decisions. Let's begin. The first trap, and perhaps the most dangerous, is overconfidence bias. Here's how it works. The more intelligent you are, the more you trust your own judgment, which seems logical, except when you're wrong. Studies show that experts are often more overconfident than novices. They've succeeded before, they have credentials, they have experience, so they assume their judgment is sound. But intelligence creates a blind spot. You're smart enough to construct elaborate justifications for bad decisions. You can rationalize anything. A 1998 study by Terence O'Dean analyzed over 10,000 brokerage accounts. He found that the most active traders, the ones making the most decisions, underperformed the market by 6.5% annually. These weren't random people. These were educated investors, confident in their ability to beat the market. And that confidence cost them dearly. The paradox is this. Intelligence gives you the tools to analyze, but overconfidence makes you skip the analysis. You trust your gut, your pattern recognition, your quick read of the situation. And sometimes, your gut is just indigestion. Next, the anchoring effect. Your brain loves reference points. It needs them. It uses them to make sense of numbers. But here's the problem, the first number you see becomes the anchor, and it distorts everything else. Imagine you're shopping for a house. The first one you see is listed at $800,000. It's nice, but not perfect. The next house is $700,000. Suddenly it feels like a bargain, even if it's still overpriced for the market. That initial $800,000, that's your anchor now. Everything is judged relative to it. Or consider stock prices. A stock that was once $200 per share, now trading at $50, feels like a steal, like it must bounce back. But what if the company's fundamentals changed? What if it's actually worth $30 now? That historical high, that's just an arbitrary anchor. It has no bearing on future value, but it shapes your perception completely. Kahneman and Tversky demonstrated this with a famous experiment. They spun a wheel with numbers 1 through 100, then asked people to estimate the percentage of African nations in the UN. The wheel's random number, completely irrelevant, influenced their answers by significant margins. If a random number can do that, imagine what carefully placed anchors do in financial marketing. Then there's recency bias, the tendency to overweight recent events. Your brain is a prediction machine. It looks at recent patterns and assumes they'll continue. The market has been going up for 3 years. Therefore it will keep going up. This feels like analysis, but it's just pattern recognition. After the 2008 financial crisis, people swore off stocks. Real estate felt too risky. Everyone wanted the safety of bonds. But that was exactly the wrong time for those decisions. The best opportunities emerge after crashes, not before them. Recency bias works both ways. After a boom, people forget risk exists. After a bust, they forget opportunity exists. Smart people fall for this because they can construct sophisticated narratives. They create complex theories about why this time is different, why the recent trend represents a fundamental shift. But most of the time, it's just a cycle, doing what cycles do. Finally, mental accounting, one of the most subtle traps. This is where you treat money differently based on arbitrary categories. Found $20 on the street. That's fun money, you'll blow it on something frivolous. But $20 from your salary. That's serious money, you'll save it or spend it carefully. Same $20, different mental account. Richard Thaler, who won the Nobel Prize for his work on this, described how people put money in 2 different mental buckets. There's the retirement bucket, the emergency bucket, the vacation bucket. And once money is in a bucket, it's hard to move, even when that would be the rational choice. Here's a real example. Someone carries credit card debt at 19% interest, while keeping a savings account earning 1%, because the savings are in the emergency bucket. That's costing them 18% annually, for the comfort of mental separation. Or consider house money effect. Gamblers who win big early start taking bigger risks, because it's the casino's money now, not theirs. Except it is their money. Objectively, money is fungible, $1 equals another. But our brains don't work that way. We create stories, categories, emotional separations. And smart people are particularly good at creating elaborate mental accounting systems, with complex rules and justifications, that ultimately lead to suboptimal decisions. These 4 biases, overconfidence, anchoring, recency bias, and mental accounting, they're not bugs in our thinking. They're features, designed for a different world. But in finance, they're expensive features. Let's talk about long-term capital management. LTCM for short. 1994. A hedge fund launches with an unprecedented dream team. 2 Nobel Prize winners in economics. Myron Scholes and Robert Merton, developers of the Black-Scholes options pricing model. The partners included PhDs from MIT and Harvard. Former vice chairman of the Federal Reserve. Top traders from Salomon Brothers. This wasn't just smart money. This was genius money. Their strategy: exploit tiny price discrepancies in bond markets, using sophisticated mathematical models and massive leverage. For 3 years, it worked beautifully. Returns exceeded 40% annually. They were printing money. But here's where the cognitive biases kicked in. Overconfidence. They believed their models were infallible. Their intelligence had always worked before, why would it fail now? They used leverage ratios of 25 to 1, sometimes higher. One small miscalculation, and they'd be wiped out. Anchoring. Their models were based on historical volatility patterns. Those patterns became their anchor, their reference point for risk. When the Russian financial crisis hit in 1998, markets behaved nothing like the models predicted. Correlations that were supposed to be stable broke down. Prices moved in ways the math said were virtually impossible. In a matter of weeks, they lost $4.6 billion. The Federal Reserve had to orchestrate a bailout, fearing systemic collapse. The smartest people in finance, brought down by the same cognitive traps that catch amateur investors. Their intelligence didn't protect them. In some ways, it made them more vulnerable, because they could construct such convincing rationales for taking massive risks. Or consider the dot-com bubble, 1999 to 2000. This wasn't just day traders and novices buying pets.com. Venture capitalists, seasoned investors, brilliant technologists, all caught up in the same mania. Recency bias in full effect. The internet was changing everything. Companies with no revenue were valued in billions. And for a while, that worked. Every month brought new highs. Every skeptic was proven wrong. The recent past said the boom would continue forever. Smart people created elaborate justifications. Network effects. First mover advantage. The new economy. Traditional metrics don't apply anymore. That last phrase. This time it's different. That's the anthem of every bubble. And intelligence makes it worse. Because smart people can generate more sophisticated versions of that same delusion. They could explain, in intricate detail, why traditional price-to-earnings ratios were obsolete, why profitability didn't matter yet, why eyeballs and click-through rates were the real metrics. Mental accounting played a role too. This was tech money, not like regular stocks. It belonged in a different category, governed by different rules. When the bubble burst, the Nasdaq fell 78%. Trillions in wealth evaporated. The intelligence that created the rationalizations couldn't prevent the losses. Fast forward to recent history, the crypto boom and bust cycles. Late 2017. Bitcoin hit nearly $20,000. The narrative, decentralization, the future of money, get in now or miss out forever. Smart people, software engineers, finance professionals, tech entrepreneurs, pouring money into cryptocurrencies. All for biases working together. Overconfidence in their ability to understand the technology. Anchoring to peak prices. Recency bias from the rapid rise. Mental accounting that treated crypto differently from other investments. By December 2017, people were taking out second mortgages, liquidating retirement accounts, convinced they were early to the future. Then came the crash. Bitcoin dropped to $3,200 by December 2018, down 84%. But here's the fascinating part. Many of the smartest investors held through the crash, or bought more, anchored to that $20,000 peak, convinced it would return. Some were right eventually. Bitcoin did reach new highs. But many others rotated into altcoins that never recovered, or got caught in the next cycle. 2021. Bitcoin hit 69,000. The cycle repeats. New rationalizations, new certainties, same cognitive traps. These examples share a pattern. Intelligence provides the tools to analyze, but cognitive biases corrupt the analysis. The smarter you are, the more convincing your self-deception can be. Now let's talk about emotions, because knowing the biases doesn't make you immune. Fear and greed, the twin engines of market cycles. They override rational analysis, even when you know better. Warren Buffett has a famous quote. Be fearful when others are greedy, and greedy when others are fearful. Simple advice, but nearly impossible to execute, because when everyone around you is making money, your brain screams. You're missing out, you're being left behind. That's not greed exactly. It's social anxiety, loss aversion, fear of regret, all wrapped together. And when markets crash, when everyone is panicking, your brain screams again. Get out now, save what you can, it's all going to zero. That's not rational analysis. That's ancient survival instincts. The same instincts that made our ancestors run from predators. Except in finance, running from the predator means selling at the bottom, buying at the top. Smart people feel these emotions just as intensely. They just have better vocabularies to describe them, more sophisticated frameworks to justify them. Loss aversion, discovered by Kahneman and Tversky, is particularly powerful. The pain of losing $100 is roughly twice as strong as the pleasure of gaining $100. We're not wired to maximize gains. We're wired to avoid losses. This creates all kinds of problems. You hold losing investments too long, hoping they'll recover, because realizing the loss feels unbearable. Meanwhile, you sell winning investments too early, because you want to lock in the gain, you can't stand the thought of it disappearing. The rational move, cut losses short, let winners run. But our emotions push us toward the exact opposite. Smart people understand loss aversion intellectually. They can explain it in detail. They can see it in others. But when it's their money, their decision, the emotion overwhelms the knowledge. Intelligence doesn't make you less emotional. It just makes you better at rationalizing emotional decisions. Finally, herd mentality, the tendency to follow the crowd. We're social creatures. We look to others for cues about reality. This worked great on the savannah. If everyone's running, you should probably run too. But in finance, the crowd is often wrong, especially at extremes. When everyone believes stocks only go up, that's usually near a top. When everyone believes they only go down, that's usually near a bottom. John Maynard Keynes captured this perfectly. The market can remain irrational longer than you can remain solvent. Being right against the crowd requires not just different information, but different emotional wiring, the ability to feel comfortable when everyone else thinks you're crazy. Smart people are particularly vulnerable to sophisticated herds. When all your peers, other smart people, are buying something, the social proof is overwhelming. You don't want to be the one who missed it, who didn't see what everyone else saw, who failed to adapt to the new paradigm. FOMO, fear of missing out. It's not about stupidity. It's about belonging, about not being left behind by your tribe. These emotional factors, fear, greed, loss aversion, herd mentality, they don't respect intelligence. They operate on a different system entirely. Your rational brain can understand them, but your emotional brain is driving. So what's the solution? How do we make better decisions? First principle, systems over willpower. Don't try to overcome biases through force of will. You can't think your way out of emotional responses, at least not consistently. Instead, design systems that work around your biases. Automatic investing, same amount, same day, every month, regardless of market conditions. This removes the decision, removes the emotion, removes the opportunity for bias. Rebalancing on a schedule, not based on feelings. If your target is 60% stocks, and it drifts to 70%, you sell some stocks mechanically, no judgment required. The system does the thinking. Your job is just to follow the system. This is why index investing works so well. Not because it's intellectually superior, but because it removes most decisions, and therefore most opportunities for bias. Second, pre-commitment strategies. Odysseus tied himself to the mast, so he couldn't respond to the siren's song. He knew his future self would be compromised, so he constrained his options in advance. You can do the same. Write down your investment thesis. What would have to change for you to sell? What would have to happen for you to buy more? Then, when emotions run high, you have a reference point, something written when you were calm and rational. Pre-commit to holding periods. No selling for 5 years. No checking prices daily. Remove the temptation to react. Pre-commit to loss limits. If an investment drops 20%, you sell automatically, no exceptions, no hope, no waiting for recovery. These strategies work, not because they are smarter, but because they are mechanical. They remove discretion, which removes bias. Finally, second-order thinking. Don't just ask, is this a good investment? Ask, why is this opportunity available to me? What does the person selling know that I don't? If this is so obvious, why isn't everyone doing it? Think in probabilities, not certainties. Smart people love certainty, they hate saying, I don't know. But admitting uncertainty is the first step toward wisdom. Ask yourself, what would I have to believe for this to be true? Then examine those beliefs. Are they based on evidence, or on bias? This framework, systems, pre-commitment, second-order thinking. It won't make you perfect, but it will make you better. So here's what we've learned. Intelligence is a tool, but like any tool, it can be misused. The biases we discussed, overconfidence, anchoring, recency bias, mental accounting, they affect everyone. PhD or dropout. Nobel Prize winner or novice. The real-world examples prove this. LTCM, the dot-com bubble, crypto cycles. Brilliance doesn't protect you, sometimes it makes you more vulnerable. Emotions compound the problem. Fear and greed, loss aversion, herd mentality. They operate below the level of rational thought. But there's hope. Systems over willpower. Pre-commitment over flexibility. Second-order thinking over first impressions. The goal isn't to become emotionless, or to eliminate biases. That's impossible. The goal is to recognize them, to build systems that account for them, to make decisions from a place of humility rather than certainty. Intelligence is knowing the traps. Wisdom is avoiding them anyway. Thanks for watching. In our next video, we'll explore practical strategies for building wealth that work with your psychology, not against it. Hit subscribe if you found this valuable, and I'll see you in the next one.